Imagine walking into a store that once buzzed with life, where eager gamers flocked to buy the latest releases, only to find its shelves half empty, gathering dust. This is the stark reality for GameStop, a retail giant on the brink of collapse. GameStop, founded in 1984, was once a titan of the gaming world. It revolutionized the way we bought and sold video games by offering used titles at bargain prices, creating an entire secondary market in the process. At its peak in 2007, GameStop boasted over 5,000 stores across the globe and reported revenues of $9.5 billion. But times have changed. The advent of digital distribution platforms like Steam and the App Store, coupled with the rise of online retailers like Amazon, has left GameStop struggling to adapt. In an era where physical copies of games are becoming obsolete, GameStop's business model is on shaky ground. In 2019, GameStop reported a net loss of $832 million, a staggering figure that sent shockwaves to the financial world. Its market capitalization plummeted from a high of $14.5 billion in 2007 to just over $200 million today, leaving many wondering if this once thriving company can turn things around. The story of GameStop is more than just a tale of a failing business. It's a cautionary tale about the dangers of clinging to outdated models in an ever-evolving marketplace. As we delve deeper into the financial history of this embattled company, we'll uncover the forces that drove it to the brink and explore what lies ahead for its future, if there is one at all. In recent years, a new breed of investors has emerged, emboldened by their collective power and wielding social media as their weapon of choice. These retail investors, or non-professional individual investors, have found an unlikely home on Reddit, a popular online forum. In early 2021, they set their sights on GameStop, a struggling brick-and-mortar video game retailer, in what would become one of the most dramatic battles between Wall Street and Main Street in financial history. Led by an anonymous user named DeepFuckingValue, or DFV, Reddit's Wall Street Bets community began buying up shares and options of GameStop in mid-2020. As more users joined the cause, the stock price started to climb dramatically, from $17.25 per share at the beginning of January 2021 to an astounding $4.83 at its peak on January 28th. This meteoric rise defied all expectations and left professional hedge funds, who had bet against GameStop's success, scrambling to cover their losses. At the heart of this upheaval was the decentralized nature of Reddit and social media platforms. With no central authority or hierarchy, these digital spaces empowered retail investors to share information, strategies, and resources in real time. This collective intelligence, combined with a shared desire to take on Wall Street giants, created an unprecedented force in financial markets. The story of GameStop's resurgence is not just about the power of social media, though. It also highlights the shifting balance between institutional and retail investors. As more people gain access to information and investment tools, they are increasingly capable of challenging traditional financial institutions. The war between Reddit and Wall Street serves as a reminder that the world of finance is evolving rapidly, and that those who fail to adapt may be left behind. In this new landscape, understanding the dynamics between social media, retail investors, and established financial institutions is crucial for anyone looking to navigate the complex world of modern finance. As we continue our investigation into GameStop's tumultuous journey, we'll explore how these forces collided and examine the broader implications for both Main Street and Wall Street. In the heart of this financial saga lies a pivotal player, the Wall Street Bets forum on Reddit. This online community, with its motto, like 4chan found a Bloomberg terminal, became an unlikely catalyst in GameStop's unprecedented stock surge. Wall Street Bets, or WSB, was formed in 2012 by Jamie Rogozinski as a space for retail investors to share ideas and strategies. Over time, it evolved into something far more potent, a haven for high-risk, high-reward trades fueled by camaraderie, humor, and a shared desire to take on Wall Street titans. By January 2021, WSB had amassed over 2 million members. One such member, going by the handle DeepFuckingValue, caught the attention of fellow users when he started posting about his substantial investment in GameStop. His conviction sparked interest among others, who then began buying shares and call options, driving up the price dramatically. On January 25, GameStop stock hit an intraday high of $4.83 per share, a staggering increase from its $17 value just 2 weeks prior. This meteoric rise defied all traditional financial logic, leaving professional analysts baffled and hedge funds reeling from massive losses. The impact was seismic. Melvin Capital, a prominent short-selling firm that had bet against GameStop, reportedly lost billions due to the surge. Other institutional investors who had also shorted GameStop were forced to cover their positions, further inflating the stock price. WSB's influence extended beyond individual hedge funds. The trading frenzy disrupted the entire market, causing wild volatility and triggering circuit breakers designed to prevent catastrophic crashes. Regulatory bodies like the Securities and Exchange Commission stepped in to investigate potential manipulation, drawing comparisons to historic cases of market manipulation such as the 1920s pump and dump schemes. As we delve deeper into this tale, we find ourselves at the intersection of social media, retail investment, and established financial institutions. The GameStop phenomenon serves as a stark reminder that these worlds are not as separate as they once were. It's a new era where power dynamics are shifting, where everyday investors can band together and challenge the mightiest players on Wall Street. 2019, a pivotal year for GameStop. The video game retailer, once a titan of the industry, was struggling to adapt to the digital age. Its stock price reflected this struggle, hovering around 5 a share, a far cry from its heyday when it traded in double digits. Meanwhile, hedge funds saw an opportunity. They initiated short selling, a practice where investors bet on a stock's decline. One such firm was Citron Research, run by notorious short seller Andrew Left. In January 2021, Left published a report labeling GameStop as a failing mall-based retailer and predicted its stock would plummet to 20. This sparked a flurry of short selling, with many hedge funds following suit, including Melvin Capital, which reportedly had a 53 million short position in GameStop. However, the narrative began to change when users on the subreddit Wall Street Bets caught wind of the massive short positions. These retail investors, many of whom were young and inexperienced, saw an opportunity for a collective squeeze. A situation where heavy short selling can lead to a stock's rapid rise as short sellers scramble to cover their positions. The plan worked better than anyone could have anticipated. As more and more retail investors bought into GameStop, its price skyrocketed, peaking at $4.83 per share on January 28, 2021. This meteoric rise left hedge funds like Melvin Capital reeling, forcing them to close their short positions and incurring billions of dollars in losses. But the story doesn't end there. Regulatory bodies stepped in, with agencies like the Securities and Exchange Commission launching investigations into potential market manipulation. The incident also highlighted the power dynamics that play in today's financial markets, where social media can mobilize thousands to challenge Wall Street giants. In this new era, understanding these complex relationships between hedge funds, short selling, and retail investors is crucial. It's no longer just about numbers and graphs, it's about people, power, and the ability to influence markets on a massive scale. 2021. A watershed moment in financial history was sparked by a subreddit called Wall Street Bets, a community of individual investors challenging the mighty institutions of Wall Street. The David and Goliath narrative played out on the world stage as these retail investors took on hedge funds armed with deep pockets and sophisticated trading algorithms. One pivotal character in this saga is Keith Gill, an individual investor also known by his Reddit username DeepFuckingValue. In June 2019, Gill invested $53,000 in GameStop, a struggling video game retailer that short sellers believed was on its last legs. As the stock price began to climb, Gill continued to buy shares and promote his long position on Wall Street Bets. On the other side of this battle were heavyweight hedge funds like Melvin Capital and Citron Research. These institutions had bet billions against GameStop, hoping to profit from its inevitable decline. However, as more individual investors joined DFV's crusade, they drove up the price, squeezing the short sellers who were forced to buy back shares at a significant loss. The catalyst for this financial revolution was social media, specifically Reddit, which allowed these retail investors to organize and share information. In January 2021, Wall Street Bets exploded with more than 8 million members, and the hashtag EGME began trending on Twitter. As a result, GameStop's stock price soared from $17.25 on January 4 to an intraday high of $4.83 on January 28, a staggering increase of over 2024. This uprising highlighted the power dynamics at play in today's financial markets. While hedge funds and institutional investors once held all the cards, social media has leveled the playing field, enabling ordinary people to band together and challenge the status quo. The story of GameStop and Wall Street Bets is a testament to the fact that real people can make a difference in the world of finance, one trade at a time. In this new era, understanding these complex relationships between hedge funds, short selling, and retail investors is crucial. It's no longer just about numbers and graphs, it's about people, power, and the ability to influence markets on a massive scale. As individual investors continue to find their voices and flex their collective muscle, Wall Street will undoubtedly feel the heat and perhaps even learn a thing or two about the true power of the crowd. 2021 will forever be remembered as a pivotal moment in financial history when a Reddit forum called Wall Street Bets took on institutional giants, upending traditional power dynamics. The event that sparked this showdown was the dramatic surge in GameStop's stock price, driven by an army of retail investors organized through social media. However, as the dust settles, serious questions about market manipulation and regulatory oversight have emerged. GameStop, a brick-and-mortar video game retailer, had been on Wall Street's radar for some time due to its struggle against digital distribution platforms. Hedge funds like Melvin Capital and Citron Research saw an opportunity to profit from this decline by short-selling the company's stock, essentially betting that its price would fall. But as more shares were sold short than actually existed, a situation known as a short squeeze became possible. Enter Wall Street Bets, a community of day traders and amateur investors who saw an opportunity to make a profit while also striking a blow against the hedge funds. By encouraging members to buy and hold GameStop shares, they triggered the predicted short squeeze, causing prices to skyrocket by over 2,000% in January alone. This sudden surge left hedge funds scrambling to cover their positions, resulting in billions of dollars in losses. However, this victory for the little guys has not come without controversy. Market manipulation accusations have been leveled against both sides, with critics arguing that Wall Street Bets' actions constitute a pump-and-dump scheme, artificially inflating stock prices before selling them off at peak value. Meanwhile, others claim that the hedge fund's initial short positions were themselves an attempt to manipulate the market by driving down GameStop's share price. Regulatory bodies like the Securities and Exchange Commission are now faced with the challenge of untangling these complex allegations and determining whether any laws have been broken. The outcome will set a precedent for how future cases involving social media-fueled market activity are handled, potentially reshaping financial regulations in the process. As individual investors continue to find their voices and flex their collective muscle, Wall Street will undoubtedly feel the heat and perhaps even learn a thing or two about the true power of the crowd. But as this new era dawns, it's crucial that all parties involved understand the rules of engagement and respect the boundaries set forth by regulatory bodies. After all, a fair market benefits everyone, from the smallest retail investor to the largest hedge fund. The events of January 2021, when a Reddit forum sent GameStop stock soaring, have profound long-term implications for retail investors, Wall Street, and market regulation. This uprising not only exposed vulnerabilities in the financial system, but also underscored the need for clearer rules and safeguards. Retail investors, who until now have been largely dismissed as insignificant players, have tasted blood. They've seen their collective action drive volatility in the markets, inflicting pain on hedge funds that had bet against GameStop. This newfound power could inspire more individuals to participate in stock trading, potentially leading to a surge in retail investment. However, it also raises concerns about inexperienced investors being lured into risky behaviors without fully understanding the consequences. On Wall Street, firms are scrambling to understand what this means for their businesses. Some are already exploring ways to tap into the power of social media and online communities. Others are calling for tighter regulations to prevent another Reddit-fueled frenzy. Regardless of their stance, one thing is clear: traditional financial institutions can no longer ignore the voice of the crowd. Market regulators face an uphill battle in striking a balance between fostering innovation and maintaining stability. The Securities and Exchange Commission launched a probe into the GameStop saga, aiming to examine potential irregularities and manipulations. However, crafting new regulations that address the nuances of social media-driven investing will be no easy task. Any missteps could either stifle innovation or leave loopholes for bad actors to exploit. In this new era, education and transparency become paramount. Investors must understand the risks associated with complex financial instruments, while financial institutions should clearly disclose their practices. Regulators, too, have a role to play in ensuring fairness and accountability in the markets. The GameStop incident served as a wake-up call for all stakeholders. As we move forward, it's crucial that we learn from this episode and work together to build a financial system that is resilient, inclusive, and guided by sound principles of regulation. Only then can we ensure that the power of the crowd works for the benefit of all, rather than becoming a tool for manipulation and instability. Let's return to where it all began: GameStop, a brick-and-mortar video game retailer struggling to stay afloat in an increasingly digital world. Melvin Capital, a hedge fund, decided to short the company's stock, wagering billions that GameStop would fail. But then, something extraordinary happened. A subreddit called Wall Street Bets, with over 10 million users, caught wind of this bet against GameStop. They saw an opportunity and rallied together to drive up the price, squeezing Melvin Capital and other short sellers. This digital rebellion was led by individual investors like Keith Gill, who goes by Roaring Kitty online, and became a symbol of the struggle between Wall Street and Main Street. The numbers are staggering. GameStop's stock price skyrocketed from 17 at the beginning of January 2021 to an intraday high of 483 just weeks later. Melvin Capital suffered massive losses, requiring a $1 billion bailout from other hedge funds, and the total value lost by short sellers is estimated to be over $20 billion. But this isn't just a story about winning or losing money, it's also about exposing deep flaws in our financial system. Regulators are now investigating potential market manipulation and illegal trading practices from both sides of the trade. The Securities and Exchange Commission has launched a probe into the actions of Reddit users, while simultaneously examining whether short sellers like Melvin Capital followed proper disclosure rules. The GameStop saga reveals that our financial system remains vulnerable to volatile market swings and unchecked speculation. It underscores the need for stronger regulations and better oversight, especially when it comes to short selling and stock lending practices. Furthermore, it highlights the importance of financial literacy, as many individual investors were left wondering how they could participate in this new digital frontier. As we move forward, let us remember that the power of collective action can bring about significant change, both positive and negative. This watershed moment must serve as a catalyst for reform, pushing us to build a more stable, equitable financial system where all participants have an opportunity to prosper. In conclusion, the GameStop short squeeze will forever be etched in our memories as a turning point in financial history. It's a story of David versus Goliath, of the power of social media, and of the urgent need for reform. Above all, it's a reminder that the rules governing our financial markets must adapt to reflect the realities of today's interconnected world, or risk being swept away by the tides of change.